If someone gave you a choice today, option 1, try to beat millions of professional investors, hedge funds, and institutions, or option 2, quietly own a piece of everything they're all fighting over. Most people would choose option 1, and that single decision is why most investors lose money. Index funds are not exciting. They are not flashy. They do not promise overnight riches, yet they have quietly created more millionaires than almost any other investment strategy in history. Today, I'm going to explain index funds in the simplest way possible, how they work, why they outperform most investors, and why ignoring them may cost you more than you realize. Stay until the end. The final section reveals why simplicity, not intelligence, is the real advantage in investing. 1. The problem index funds were designed to solve. To understand index funds, we need to start with a problem. For decades, people believed successful investing meant picking the right stocks, timing the market, outsmarting everyone else. This belief created an entire industry of stock pickers, fund managers, analysts, and financial TV shows. But here's the inconvenient truth. Most professionals fail to beat the market over time. Not sometimes, not occasionally, consistently. After fees, taxes, and mistakes, the majority underperforms simple market averages. This raised a powerful question. If beating the market is so hard, why not just own the market? That question gave birth to index funds. 2. What an index actually is. An index is simply a list, a collection of companies grouped together to represent a market or sector. For example, the S&P 500 represents 500 large U.S. companies. The FTSE 100 represents major UK companies. The TSX Composite represents large Canadian companies. An index is not an investment itself. You cannot buy an index directly. It's just a measuring stick, a snapshot of how a group of companies is performing. Index funds exist to track these lists. They don't try to beat them, they simply follow them. 3. What an index fund really is. An index fund is a basket of investments designed to mirror an index. When you buy an index fund, you instantly own small pieces of hundreds or thousands of companies. Your money is spread across the entire market. Your risk is diversified automatically. Instead of betting on a single company, you're betting on the long-term growth of the economy itself. No stock picking, no predictions, no guessing, just ownership. 4. Why this simple idea is so powerful. Most people underestimate how powerful diversification is. Individual companies fail all the time. Industries collapse. Trends change. But economies tend to grow over long periods. Index funds don't need to know which company will win, which industry will dominate, which stock will fail. They own everything and let progress do the work. Winners naturally rise, losers fade out. The index adjusts automatically. This is evolution applied to investing. 5. The cost advantage. One of the most overlooked benefits of index funds is cost. Actively managed funds charge higher fees because they employ analysts, managers, and traders. Index funds require far less intervention. Lower fees mean more of your money stays invested, more compounding works faster, and long-term returns improve significantly. Even a 1% difference in fees can cost hundreds of thousands of dollars over decades. Index funds quietly win by simply charging less. 6. Why most active investors lose. Let's be clear. For every investor who beats the market, another must underperform. Markets are competitive by nature. After costs, taxes, and errors, the average investor must lose. Index funds accept this reality instead of fighting it. They don't aim to be above average, they aim to be the average, which already beats most participants. This humility is their secret weapon. 7. The psychology advantage. Index funds don't just protect money, they protect behavior. Because they reduce the urge to trade, eliminate stock-picking anxiety, and remove constant decision-making, they help investors stay invested. Staying invested matters more than brilliance. Many people fail not because of bad assets, but because of bad timing driven by emotion. Index funds make patience easier. 8. Real numbers: how index funds build wealth. Let's use simple math. If you invest consistently over decades in a broad market index, you benefit from economic growth, reinvested dividends, and compounding returns. Small, regular contributions grow into large sums over time, not because of genius, but because of consistency. Time does the heavy lifting. 9. Common myths about index funds. Myth 1. Index funds are too slow. Reality: slow and steady often wins. Myth 2. They're only for beginners. Reality: most of the world's smartest investors use them. Myth 3. You can't get rich with them. Reality: most wealth is built quietly, not dramatically. Myth 4. You miss out on big winners. Reality: index funds own the winners automatically. 10. When index funds don't work. Index funds aren't magic. They don't protect against short-term losses. They don't eliminate market downturns. They require patience and discipline. They reward long-term thinking. They punish impatience. Used incorrectly, they can still fail. Used correctly, they are incredibly powerful. 11. How the wealthy use index funds. Wealthy investors often use index funds as core holdings, long-term foundations, and risk management tools. They may add other assets, but index funds form the base. Simple, reliable, efficient. 12. Why simple beats complex. Complex strategies sound impressive. Simple strategies work. Markets reward discipline, not creativity. Index funds succeed because they remove unnecessary complexity. They don't rely on predictions, they rely on progress. 13. The real reason people ignore index funds. Index funds are boring, and boredom is their advantage. Excitement sells. Simplicity compounds. Most people chase excitement and pay for it with poor returns. Those who embrace boredom often win quietly. Closing. Index funds won't impress your friends. They won't make headlines. They won't give you bragging rights, but they work. In a world obsessed with shortcuts, they reward patience. In a market driven by emotion, they reward discipline. Own the market. Let time do the rest. Subscribe to the Wealth Code, where wealth is built with clarity, not noise. You rich.